Alright guys, in today's video I got a new strategy that I've been trying out that I'm pretty excited to talk to you about. I was able to make $75 on a $420 risk assessment, meaning that I netted about an 18% return on investment today. What's up guys, welcome back to Modern Options, where I'm trying to help the average investor understand options a little bit better. Alright guys, so the trade that I executed today was called the 0 day to expiration strategy. So I like to do this on the SPX, which is the index that follows the S&P 500. So what is the 0 day to expiration? All that means is I am trading a contract that is expiring the exact same day that I open it. It can be very risky if you don't have the proper risk management set up. So these are the ground rules that I use when I enter these types of trades. So first, I like to trade it on the SPX because you can do it on Monday, Wednesday, and Friday. It has 3 different expirations throughout the week, which allows you to execute the trade more often. And it helps you align with the pattern day trader rule if your account's less than 25,000, where you can make 1 trade per day for 3 days a week and not break the pattern day trading rule. Second rule is that I like to wait 30 minutes until after the market opens. There's way too much volatility in the beginning. The market could turn around and have a reversal at any second. So I usually like to wait and let it fizzle out and choose its direction for the day. The next ground rule I like to use is I like to pick my strikes that are usually about the 90% chance of expiring out of the money, which is on or about a 10 delta or so. And I'll fluctuate this anywhere between 2 to 3%. So sometimes I might do 87 or 93, depending on how good the premium is for the day. And one of the key parts of this strategy is that you have to respect your stop loss. Otherwise, you can suffer a max loss and wipe out 3 or 4 previous trades that you did. So I like to set my stop loss at 2 to 2.5 times the premium received. Now this play that I do can either be done with a credit spread or an iron condor. If you're overly bearish on the day, you're going to want to use a call credit spread. If you're overly bullish on the day, you want to use a put credit spread. Or if you think that it won't go too far in either direction, you can set up an iron condor. So let's go ahead and look at the Thinkorswim chart here. I'm on the 5-minute chart on SPX. Now, what I did first before entering this trade, I went through the past 2 previous trading days to see where some key resistance or support levels were. And I marked a few out. The low of 2 days ago was somewhere around 41.83, and then the low right before the market closed was around 41.91. And into the next day, the trading highs, you could see it hit a resistance point of about 42.13, and the low for the day was around 41.97. So I try to keep these in mind when I went to see which strikes actually had 90% chance of expiring out of the money. So let's go ahead and zoom in here. Now, right when the market opened, you can see that there's a super big green candle hitting an all-time high for the day, about 42.16. And going along, so what is this, about 10 o'clock, it still could not pass that 216 resistance point. So I felt that that was pretty strong and that I would have a good chance of it not breaking that for the day. And as for the bottom, it didn't really go too low, only to 42.09 within the first 30 minutes, but I tried to look at the previous day's low to make a choice for my put side of the iron condor. So at the time that I wanted to enter the iron condor, which, let's go over to the monitor tab, I entered it about 10:13. So at that point, the SPY was trading anywhere between 42.10 to 42.09 in this candle here. And the 90% chance of expiring out of the money was at the 41.85 strike price. So I ended up keeping that as my put side because I didn't want any sort of bad news to come out and just have an extreme fall down to these levels where it was previously 2 days ago. And with it hitting this resistance point at 42.16, I had a pretty good feeling that it wouldn't break that as well. So I decided to bring my short leg in on the call side a little bit higher than 90%, probably closer to 87, and to get some good premium out of it. And when I entered that trade, I received 80 cents in credit on a $5 wide iron condor, meaning that each side of the iron condor was only 5 strikes apart. So you can see on the put side, I sold the 41.85 and bought the 41.80. And on the call side, I sold the 42.25 and bought the 42.30. This means that you can't lose any more than $500, but since I received 80 cents up front, that means I couldn't lose any more than $420. But the key to this was that I put in a buy order, a stop limit order, as soon as I opened it in case that it would blow through. So I put in a stop limit with a 1.55 stop and a 1.65 limit. So 2 times the credit of 80 cents would be 160. So I didn't want to pay any more than 160 in case that this decided to test one of my sides. But I wanted it to not execute right away. If you put in a limit order, it would have just bought whatever the price was currently at. So this means that the price of my iron condor would have had to have reached $1.55 before this limit order was activated. I put it about 10 cents apart that way in case that it's falling fast. It doesn't just blow right through my limit order and I don't get a fill and I suffer a max loss. So yes, even though it's a $5 wide spread and I received 80 cents, my technical max loss is $420. But with this stop limit in, my max loss would only be $85 or 85 cents. So that's one thing I love about this strategy, is that you can really define your own risk and don't have to suffer any sort of overnight gaps that could truly destroy any iron condor. And then you just kind of let it go. Your stop loss will either trigger and you will come out at a loss, but it allows you to trade another day, or you can hopefully expire worthless or buy it for almost nothing at the end of the day. So as the day went on, it tested that 416 resistance points a couple times, and I was pretty happy with that. It wasn't breaking to any new levels, but then it did, which made me slightly nervous for a little bit of the day. But if you look down here at the RSI, it was at really overbought levels, right at the 70 mark or so, when it hit those all-time highs. So I was pretty comfortable holding and not going ahead and just canceling my stop loss order and just suffering the, I don't know, $30 to $40 loss that it would have been right there, and decided to hold. But I set an alert around 419 or 420 range to let me know if it was going to break through that level. And then by 12:45, it ended up trending downward, and my iron condor's value started to plummet. So I just decided to hold it throughout the end of the day. I had put in an order to try and buy my call side, maybe about 5 cents around 3:45, but it didn't fill, and I was pretty confident that it wasn't going to go back up, so I just go ahead and canceled it and hoped that it would expire worthless. There was a pretty big fall here towards the end of the day, but it didn't come anywhere close to my put credit spread strikes. So that just means that I got to keep all 80 cents of that today, minus the $5 that I had to pay in fees, and then I netted $75 for the day on a $420 investment, or max risk. So the return on investment on that is about 18%, guys, in one day. It's one reason why I really love this strategy. I'm going to be making more videos about this. I think this is a strategy I would really like to perfect and make my main strat. That's all I wanted to talk to you about today, guys, in this video. So if you have any questions, leave it in the comments section below. If you've tried 0DTE before, let me know any sort of rules that you like to take on. And guys, if this video was of any value to you, please leave a like and subscribe. It really helps out a small YouTuber. And I'll catch you guys in the next one.